Good morning, everybody. My name is Paul Myliotis. I'm Managing Director of M Squared Capital. I have today with me Paul Miron, my joint founder. Today we'll be talking about what are the questions you need to ask before investing. Before we start, however, I'll draw your attention to our disclaimer, which is basically saying today we're providing you with general information only and it should not be construed as advice. No. Before we get into the questions, what I did want to run you through is what we actually do and who we actually are. So M Squared Capital are a private credit provider, otherwise known as a non-bank lender. We match borrowers who need money with investors that have money. We pay our investors monthly. Our investments are secured investments only. We are secured via first registered mortgages over real estate assets over the eastern seaboards of Australia, predominantly in Sydney. Importantly, which is a little bit of a different concept, I think, for most, is that we operate a contributory mortgage fund.
Yeah, a lot of people are going to say, what is a contributory mortgage fund? Quite simply put, is a contributory mortgage fund allows investor to choose a specific mortgage investment that's best suited for them.
So it's not pooled into one pool of investments. You individually choose which investment suits your risk profile.
And the real reason why we have chosen that particular structure is that we believe that not one mortgage is the same. So for example, it might be under a different asset, different gearing, different tenor. We do mortgages for 3 months, 6 months, 9 months, 12 months, 3 years. So each opportunity is so different. Now our platform allows investors to create the diversity that is required in all of the different type of mortgages, and does also allow them to manage their own portfolio very well, and in transparency to choose which opportunities best suits their portfolio as well.
Yeah, I mean, look, one example of that is my father-in-law, who's an active investor into our mortgage fund. He's a self-funded retiree. He was an engineer for over 50 years. He loves the contributory nature because he doesn't want to be pulled into other investments that he doesn't like. For example, he doesn't enjoy construction. He doesn't want exposure to construction risk, so he stays away from that. We have other investors who are property developers who actually like the increased yield that being involved in construction offers. The beauty of our fund is you can choose whichever aspect you like.
And look, just like mortgages, there's different type of investors and there's different type of opportunities. So we actually do well in matching those two together.
Yeah. So moving on, COVID has structurally changed the way investments have to be made.
Yeah. It's like, look, the normal economic theory done by financial planners about asset allocation has been consistent for decades. It's usually done as 60% shares and 40% bonds, or 40% in some type of cash style product, the term deposits or money are called.
Why would they do that?
The importance of having such a split is that they know that, for example, shares goes up and down. And so why would you want to be forced to actually sell your shares at the worst possible time? So by having 40% there, it creates income or revenue for you to be able to live off, okay? And cushion the perspective of time to be able to ride the waves in relation to movements in the share market.
Right. And the structural change has meant, because now that cash style product is near zero, or with inflation you're actually maybe losing money if you're holding your monies in cash, that has driven a lot of investors to change what they actually put in that bucket, for lack of a better word, in that 40% cash style product.
And the issue that you have there as well is that, well, not an issue, but as a result, alternative investment class is growing at the moment. Okay, look. And we were a part of that alternative investment class as well, because we provide the same characteristics that people found in that 40%, but slightly different, and people need to be aware of the risks as well.
Yeah, so in saying that, alternative investments like M Squared Capital, you're going up the yield curve to get a bigger return. And I think that is where we fundamentally are getting to. You need to be asking questions before you jump into asset classes that are foreign or new, considering that the US, for argument's sake, the alternative investment space, particularly mortgage trusts, are very developed. I think
absolutely. The statistics is that 70% of all commercial mortgages done in the US are done through private credit providers.
Compare that to Australia's things about 10%, right?
It's actually less than 10%.
Yeah. So we're a growing sector.
Yeah.
There will be exposures that you're going to be seeing in that sector, but you need to be asking some fundamental questions before you jump in, and we're going to run through that right
Absolutely.
now.
And another issue that you have there as well is that access to getting these alternative investments, they're not readily available to all financial planners. So from our personal experience, all of our investors have come to us direct throughout without financial planners. So it is one of the things, and it's an extra burden for investors to find those opportunities themselves. So it's a very different time than what we've experienced the last decades in relation to investing.
So let's get into the meat of what we're actually here to talk about. What are the 5 questions you should be asking before you put $1 single into an investment?
Yep.
Okay. The first question we would ask is, do I really understand how investment or the investment actually works?
Absolutely. Look, and we see it time and time over. There are a lot of interesting brand new products in the marketplace, and they look great. The marketing is fantastic. But when you actually look at the actual detail, what are you actually being offered? Is it a debt obligation? Is it an equity? Or is it a hybrid? You really need to understand what you're being offered.
Well, look, on that note, we were talking about it the other day. We were looking at the Australian Financial Review, and we saw these glossy ads saying 11% return. Biomedical. Well, you get attracted by 11%, you get attracted by biomedical. Now,
but what is actually undercurrent asset?
Yeah.
Is it a debt facility or is it not? Or is it an equity situation? So you like Warren Buffett says, if you don't understand it, if you've read through everything and you're not absolutely crystal clear, don't do it.
Yep, we agree with that. The second aspect is, what is the actual business case for the investment? Does it actually make sense?
Absolutely. Look, at the end of the day, traditional investing has come down to cash flow. What is the cash flow being generated in this investment so that you are sharing in it?
Well, on that note, mortgage trusts, it's a simple concept. The borrower comes to you for a need for finance. They might be buying a block of units for argument's sake. The investors lend that borrower money to buy that block of units, secured via a first mortgage. The borrower pays interest to the investors share in the interest income. The flow of the income can be easily defined. You can drive past the asset, you know what you're doing. Makes sense.
Absolutely.
So the third question you must ask, and we're very passionate about it, is what is the security being on offer?
And the reason being is that if the business case hasn't worked, okay, and if the cash flow is not there, or something has not crystallized as what you've been presented, what are you relying on to preserve your capital?
So what is your collateral? What are you falling back on exactly, Paul? If something that you are told doesn't deliver, what can you rely on to get your capital back? What is the underlying security? Now, at M Squared Capital, we are very defined on what our security is. We like homogenised assets. We don't like specialised assets, and there's a reason why. So by specialised, we mean we won't lend to pubs, clubs, bowling alleys, vacant land in regional Australia. We love regional Australia, but for different reasons. And the reason why is, in the case or the unlikely event we do need to recover the monies of our investors, and you need to fire sell those assets, they are harder to sell, which means you have to drop the price, and the likelihood of loss is greater. So when we are looking at Sydney-based property predominantly, that are existing properties predominantly, the likelihood of loss is less.
Absolutely. So the other item that we would like to talk about as well is that how easily are you able to receive all the due diligence from the fund manager?
Look, I think this should be pretty simple. If you ask something from your fund manager and they do not provide it, I think that's a red flag. Let's be honest, it's the investors' monies that we are investing on their behalf. I think it is common practice that you should be able to provide that due diligence. So back to M Squared Capital, some of our investors only want to see a summary. Some of our investors want to see all the 100-page due diligence, and others just want a phone call from Paul or myself. But the fact remains, if they ask for more information, we will provide it. So to summarise that topic, are you able to access due diligence that you want whenever you want it?
It's very critical. The other item as well is that it's quite interesting with COVID as well. Will my investment withstand an unexpected economic shock or event? So look, the best investors look at what's called asymmetric risk. They look at preservation of capital. So they don't assume that whatever they're being said as a best case scenario, they assume the worst case scenario. Because if you actually lose your capital in any type of investment, it's very hard to get that capital back. You have to actually work a lot harder as well. So I think the fifth one, if COVID has actually taught us anything, is to expect the unexpected.
Look, and on that basis, going back to property trust, or more importantly, mortgage trusts, the residential property market in Australia was resilient. It didn't drop the 20% that people were saying. Historically, we can see what it's done. So, was it resilient? Absolutely. So understand the resilience of your asset class you're investing in. I think that's extremely important.
So in summary, successful investing is not always exciting. However, I think the most important thing that we need to get out of this as well is that successful investing is actually the compounding effect of your wealth increasing month to month. Also, having asset preservation and control is very critical in relation to making your right decisions. The experience for our investors is that they love the ability to be able to have the knowledge and certainty in relation to the outcomes in relation to their investment with us.
Thank you very much. If you like what you've heard from us today and you want more information on the type of investments M Squared Capital have, please email us at info@msqcapital.com.au. Feel free to call Paul or myself. Our number is on the screen. We'd love to talk to you. Thank you very much.